And like Sarah said, this is a class that typically would last a semester, and we just did it in 31 minutes. So
Exactly.
welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Welcome everyone to Alt Investing Made Easy. Today we're taking a deep dive into our first episode, Intro to Alternative Assets. Today's episode is about understanding investment structures, which are called business entities or business enterprises when you study them in law school. We're going to provide just a basic overview of the different entity types and structures, ownership, where management control resides, essentially giving a small law school class on business entity types. So, Roland, how are you today?
I'm great, Sarah. Thanks. And, you described it perfectly. We really think that when you're thinking about investments in private securities, it would be good for you to have gone to a little bit of a law school. And so that's what we're doing, is trying to repeat for you the law school experience that we had by engaging in this education role and trying to inform you. And so, yeah, that's what we sort of envision this being, Sarah, is we're wannabe law professors, and we're going to teach our audience about the different types of business entities.
It's really useful to understand it because, especially as an investor, you're encountering these different entity types all the time, and having a bit of knowledge about why they're actually different is useful. So maybe we get into it.
Yeah,
do you want to start
sure.
with the first key term?
Okay, yeah, and we're going to go through the different types of entities, and you've probably heard these terms before for sure. Everybody has heard of a corporation, probably maybe not as common as, or in people's knowledge, a limited liability company, also a limited partnership. We'll talk briefly about general partnerships, but everybody's heard of corporations and partnerships. And then we're going to also talk about the limited liability companies as well and distinguish those.
Exactly. So with a corporation, you want to take us through what a basic definition might be, Roland?
Yeah, well, all of these are, there's that, the term person, and a person can be a natural person or a legal person. And natural persons are Sarah and Roland and all other human beings, naturally created persons at law, just human beings. But legal persons are entities that are created by the law, and each state in the United States has a set of corporate laws that authorizes the creation of different types of business entities, and these are all legal persons. So when you go out into the marketplace, a reason why you would want to form an LLC or a corporation is to act through that legal person, and it limits liability for yourself as the business owner operator by being able to act through the legal person. It's like that imaginary legal person is taking the action rather than you as the business owner or manager. And there are protections that you can afford yourself of when you form business entities. Mm-hmm. But we'll start with a corporation first, okay?
Okay.
Well, the corporation is the first type of legal entity that most people are familiar with. And this is an entity that you form by filing a document with the Secretary of State, whichever state you choose to form the entity in. We're in Texas, Austin, Texas. And I think I forgot to mention that. Please note, everybody, that we are practicing attorneys, and we're available for free consultations with our audience members about any of the topics that we talk about on AIM, but for sure this topic, the different types of entities, choice of entity is another term of art. But just getting back to the specifically corporations, and if you do want to talk with us, our contact information can be found in the show notes. But corporations, I'm jumping around a little bit.
You'll get there.
Corporations. So these are the legal entities that are formed by, and the documents are called different things: certificates of formation, articles of incorporation, articles of organization. In Texas, I think they call it a certificate of formation for everything now. You file this document, and the information that is required to be recorded with the Secretary of State to form an entity, you have to have a discrete name. So, the Roland Wiederaenders Corporation, or Alt Investing Made Easy. Alt Investing Made Easy is an LLC, but we could have formed it as a corporation. So you have to have the entity, the corporation's name. And then generally you have to identify who the initial board members are. Not all states require that. But the board members are the management, the people that have the management control. And if you understand how corporations work, the equity interests of a corporation, generally the way they're set up is you issue shares of common stock. And the stockholders or the shareholders are the people that elect the board members. And then the board members go out and take actions on behalf of the corporations, and they engage officers, and the officers are actually the people that implement all the corporation's business activities. But it really all starts with the formation, naming the initial board, and then the board authorizes the sales of shares of stock to the shareholders, and then those shareholders capitalize the company. So in exchange for those shares of stock that the corporation is authorizing, the shareholders come in and say, well, we understand it's a new business, so you're going to have money. And the way that the businesses are funded are by capital contributions or purchases of shares of stock in a corporation by the shareholders. And then all of that money is taken and put into a corporation's bank account. And then the president and other officers of the corporation have check writing authority against that money, and it's just subject to their duties. But that's really the corporation in a nutshell.
And I think we'll get into some comparisons between the different kinds of of entities, after we just name them and describe a little bit about them.
There we go.
And I just want to add a caveat, Roland, which is there are actually a lot of variations of differences depending on how people want to structure the operating documents for their entities. So we're touching on the main highlights here that we think is general knowledge that will be useful for people to have. So moving on, we have the limited liability company, and notably, it's still a company, and you have members in this company. And the limited liability part is also descriptive. The limited liability company has features that are like a corporation, and it also has features that are like a partnership. But the main idea is that you have the benefit of the corporate shield when you go through the process of forming a limited liability company through the same kind of process that you form a corporation, depending on the state that you're in. And then you have the benefit of the limited liability of that corporate structure. It's its own legal person, and it contracts in its name, and it makes payments in its name, and it does other things that basically persons under the law can do. What you have in a limited liability company is also you can have the option of having a member managed LLC, which means that the owner clearly manages the company or the owners, or you have a manager managed LLC, which means that you identify managers, name those parties or people, and management is then conducted by those parties or individuals at some point, but it can also be that you name, obviously, an entity as the manager as well. So the difference here from a corporation we'll get into down below, but the basic other feature that's important about a limited liability company is that these are creations of state law, which means that at the federal level, unless you take some other actions after doing some analyses, they will be taxed as a partnership. And that can have benefits for the members if that's, in line with maybe the reason that the LLC was formed. So that in that way, this division of management and the ownership is something that's similar to having the division of management and ownership in a corporation. But then you also have a clear recognition sometimes that there's not really a real division and the owners just manage that LLC.
Yeah, maybe that is kind of a common aspect of the LLC is that it's more or less less frequently in a corporation do you have such a overlap as you do with an LLC, the overlap between the ownership and the management. I think because primarily LLCs were created as something that would be used more by small business, honestly.
Exactly. Yeah, they're more comfortable for small businesses, and you can I guess they have a different administrative burden, you could say, than a corporation does. A lesser administrative burden, perhaps, and
I think the way to say that there is that it would be you have more flexibility to vary the management, ownership, and control of the entity with the LLC. You can do it in the same way with a corporation, but it's just done in different ways. I think that's probably the best way of saying it, Sarah.
Right. Yeah, and that's important for people that invest in private assets, right, Roland? Because those variations of control are exactly one of the features of private assets. When you're talking about public assets, investment in public companies, this is very clear. Like you have a professional management that's separate from the shareholders, and there's a lot of regulation that goes and that can be involved in regulating those relationships. So,
Yeah,
you want to
for
move
sure.
on? You want to move on to limited partnership?
Yeah,
Roland?
I mean, limited partnership, it's very similar to a limited liability company in the sense that they're both taxed, as Sarah said, they're taxed like partnerships for U.S. federal income tax law purposes. Limited partnerships are owned by the limited partners and the general partner. The limited partners are more like shareholders of a corporation or the members of a limited liability company. The general partner is more like the board of directors of the corporation or the managers of a limited liability company. And the general partner has all management control. And Sarah was referencing this earlier, that it's important to understand the liability protection that is afforded to the business owners. In the limited partnership, the limited partners, their liability is limited up to the amount of their investment, but then the general partner is the one that has management control, and then the general partner can be sued and has the unlimited liability of the owners. So there, boy, this is tough, Sarah. With
There's a reason this is a full year class or at least a semester in law school.
That's right. We're trying to cram everything in, but the general partner frequently, and Sarah mentioned this with managers of a limited liability company, the general partner probably should be an entity itself because it has this unlimited liability. So we would never counsel somebody to form a limited partnership and then serve in their individual capacity as the general partner, because they could be sued and then all of their assets could be subject to the liabilities of the business.
And,
so yeah, go ahead.
Oh, I was just gonna say I wanted to make one other comment because when working with commercial real estate as one of the alternative assets that's very popular today. You hear the word general partnering a lot, like it's used as a term of art in the industry that's separate from its legal meaning in the context of a general partnership and a limited partnership. It is also the same in that the general partner is the general partner in an LP. However, I think a lot of times the structures come through as limited liabilities company, and you don't technically have a general partner there. There you have a manager. So this is one of those terms, general partner, that's used to mean different things in different contexts, even when we're talking about alternative assets like commercial real estate. But in the law, there's a very specific meaning for it.
Yeah, I think we could do a whole show on that topic.
Maybe that'll be a deep dive.
Yeah, I mean, but yeah, it is. People throw the terminology around, and as long as you understand what the meaning is behind it, then that's okay. But there's meaning and there's technical meanings that can really have significant distinction, in terms of who it is that controls the business, and just with these private securities deals with limited liquidity, that's the main question. We had a great guest, Larry Powell, on recently, and he told us about how to qualitatively evaluate the management of whatever it is that you're investing in. And that's really what's so important for these private securities deals, looking at the management and understanding who controls the entity, not only through the management, who's the president, but remember the shareholders, the limited liability company members. And then really it's just stick with those two entity types for now. Those are the people that can have control over the entity through the ownership, and it's a contractual control provision that would be in a LLC company agreement or the shareholders agreement of the corporation. But the owners can have a degree of management control, but really as an investor looking at those deals, make sure you understand who the management team is and what level of control that they have over the business.
Exactly. Which takes us to general partnership, which is, I guess you could say, arguably, general partnership is one of the oldest business entity structures around. It's been there since maybe the beginning of time.
Yeah.
In one form or another, right? Do you want to give a definition of what that is?
Well, yeah, it's where all the partners have unlimited liability. It's used very rarely. The only times that I've used it before, once we just wanted a completely pass-through entity, and I think there's a way that you can characterize the interest as not being securities in one context. So it's unusual that we would ever use them, but if we ever do use them, then the general partners are themselves going to be some kind of business entity that where the liability protection exists at that level, and then they understand, well, whatever the general partnership does, we have the same liability that we would have as if we're operating in the world directly, and there's already protections there. So we would never form, it would be highly unusual for us to form a general partnership that is made up of individuals unless they really understood that, their liability is unlimited in any event. Couldn't we have a law partnership that is a general partnership because, as attorneys, we could be sued individually, even if we operate through an LLC or whatever.
Exactly. So let's just touch on a couple other terms that are not specifically the entities, but so that we can cover those off when we talk about some of the differences that we're going to get into between these common legal structures. Basically, we're talking about management compensation, and there are these other two terms. One is management fee, and another is carried interest. And those are two terms that you hear a lot, especially in commercial real estate, but in alternative investing in general. Roland, what is generally meant by management fee?
Usually it's an assets under management based fee. And so, or it'll be a fee that's based on, by reference to the value of an asset that the entity holds. And it's usually expressed as a percentage of the value or in a per annum amount. And usually, like the management fee on a real estate deal, an asset management fee is distinguished from the property management fee. Maybe 1 to 2% of the property's value. And these are just administrative, ideally, are just covering some of the costs of maintaining an investor relations program and understanding that there are, paying for accounting and reporting of the K1s. But it's not really meant to be the place where the manager of an LLC or a limited partnership makes the most money. They're really going to be making all their money on the carried interest.
Exactly. And so then the carried interest isn't based on assets under management, but is based on performance, right?
Yeah. It's almost always calculated as a percentage of profits.
Exactly. which obviously in some contexts, a management fee would also be performance-based if the level of assets is increasing or the value of the property is increasing. But on the carried interest, there are pretty set standards in different parts of the alternative investing industry, aren't there, Roland, about how much is standard for a carried interest, how that's even calculated, you could say, and essentially it's paid in arrears after, of course, profitability is demonstrated. Unlike maybe a management fee that might be paid throughout the year or maybe in one chunk, but isn't necessarily dependent on, depending on the situation, isn't dependent on calculating profit. So,
like profit, even is sometimes, and it depends on how you define the carried interest, but a lot of times people think about, well, this is a share of profits once I've gotten my money back, my investment dollars back, plus maybe a preferred return. Or on some deals that really rely a lot on the manager skills and they think is going to be profitable, that carried interest may be applied to first dollars. So that's something that's really important when you're evaluating these private securities deals, understanding how the money gets paid out either through these fees or through the distribution of profits.
Exactly. And a lot of the so-called good deals, I would say, that we've seen, Roland, is that this carried interest portion is deferred a little bit maybe in the commercial real estate context until that first money issue is addressed and at least agreed upon in one way or another. And then the carried interest kicks in a little bit. So there are lots of different ways to do all of this, but there's definitely, I guess that's the balance between promoters of deals and investors in deals, is how these things, how they land up in any individual deal. So.
Yeah, they're all negotiated really, and there's some standard kind of, I think for a long time in the hedge fund world, people thought like a 1.5 and 20 model was really common. And so what that meant is that there's a 1.5% assets under management fee per annum, and then 20% of profits. And so how you define profits, whether that's on first dollars or after a return of capital, I think in the hedge fund world, you would just be allocated. The investor would get, any profitability on the trades. They would get 80% of them, and then 20% would be allocated to the general partner, and that would be done on an annual basis. But that was kind of a target, and that is kind of a starting place when you think about the way that some of our commercial real estate deals, the managers are compensated. They'll start out with maybe like 20% of the profits, where the investors are getting 80%.
Exactly. Well, we wanted to set out these terms for you because you definitely, if you're operating as an investor or as a promoter of deals in this space, you're hearing them, you're using them, you may already understand them, or hopefully you learned a few more things here. And, the important thing being that we've defined them as separate terms, in particular with these entities, because they are really separate concepts. You can dig into it more. There are different histories to where business entities come from, and they change a little bit over time. The regulations that states use to, the company's law of the states changes. And so for lawyers, this can be a very interesting area, but for the purposes of someone operating in this area, hopefully you have a better understanding now of these terms. What we want to do next is just talk a little further about these common legal structures and how they kind of work off of each other. Roland, do you want to do a small comparison maybe of I don't know, pick two?
Yeah, I mean, I think the first one that I would really want to pair, that I would want to focus on, are corporations and LLCs. And it's important for everybody to remember, and Sarah mentioned it before, the default tax treatment of each of these entity types. And with respect to each of these entity types, the default tax treatment really is the treatment of a partnership, where there's a single level of taxation and all the tax effects are taxed to the partners. The entity will calculate its own financial performance and the tax results from that, but then it reports all of those tax results to each individual partner on a Schedule K1, and then those partners turn around and they have to report that on their returns, whether they're individuals or it's an entity partner. But you'll hear that term a lot, single level of taxation, and that's distinguished from the default U.S. federal income tax classification of corporations, which is by default they're taxed as, you'll hear this term, a subchapter C or a C corp. And a corporation that's taxed as a C corp will have two levels of taxation. It'll have one level of tax on its income that it earns at the entity level. So the corporation goes out there and sells, tons of Xboxes, and it makes a bunch of money on that. And then Microsoft pays tax. Well, they don't really, but theoretically they would pay tax on that income, and then they turn around and they distribute profits, through dividends to the stockholders, the shareholders, and then those shareholders are also taxed on those dividends and distributions. And so that's where that double level of taxation comes through. So that's one distinction that I would make between like we use LLCs all the time.
Right.
And so distinguishing an LLC from a corporation, the way that they're taxed, that's a good comparison distinction.
Let's stick with that one because I think that really is the main one to understand for our audience members and to understand why you probably don't use corporations in many of your structures for alternative investing.
Well, it just depends, honestly, because for a long time I represented an electric motor company, and we went through 3 rounds of financing with them. They raised $38 million from VC funds, and they were organized as a corporation. And the idea behind that is their growth trajectory model was really to go out and in as short a time period as possible, either become a public company themselves, or they were going to get big enough to where they would be an attractive acquisition target for another a public company. It could have been a large private company as well, I guess, that was involved in the development of the electric motor technology. But in any event, that was their growth trajectory, and their investors, the types of investors that they were going to were the types of investors that wanted to own shares of stock, and weren't really looking for the tax effects, the pass-through tax effects from a partner, an entity that's taxed as a partnership. And that's these rules are general concepts. There's an exception to every one of them, but in that context, a VC funded private entity like that company, they wanted them to be taxed as a corporation, but in fact they initially were formed as an LLC, and that was some of the work that I did for them. Is when they did their first round of financing, the person that came in that was going to be investing in them said, well, we want to invest. We love the business, and whether you're organized as an LLC or a corporation, sorry about that. That doesn't affect the value of your ideas about the electric motor. So why don't you convert to a corporation? That was some of the first work that we did. We moved them from a Texas LLC to a Delaware C corp, and they got their funding, and as long as with that funding, that's the most important thing. And in the end, whether they were an LLC or a corporation didn't really make any difference in that instance.
I suppose also there's a scalability issue. Like as you grow and you have more and more employees, then certain things might become more straightforward when you have the corporate structure, even including, incentives for employees, any kind of equity incentives. Those types of things become simpler and also more familiar to the larger and larger investors you're looking for, right? So that becomes sort of maybe the trajectory is, and that actually just highlights that the LLC is something that's good for small and maybe medium businesses. As you grow or expect to grow into a larger organization, then it's a natural step perhaps to convert to a corporation. And the important part to note, maybe, Roland, is that conversion is possible. Like this is completely normal. So you can move between these entities, right?
Yeah, and just remember though, there's one thing that if you're really anguishing over this distinct, whether to form an LLC or a corporation, just because of the tax effects, it's easier to go from an LLC to a corporation than vice versa. There's going to be a toll charge if you go from a corporation to LLC. So that's just one thing to consider. And this is something that we talk with our clients about all the time. And that's
it.
It's worth noting.
One reason to call us if you're interested in learning more. So,
well, I think on this, Sarah, the main thing that the main idea that we really want to leave all our audience members with is that when you're investing in a private securities deal, ask a lot of questions for sure, and find out who is the management team of the deal, whether you're organized as a corporation or an LLC, a limited partnership. Ask who the management is, and then ask, what rights do I have as an investor? And they may say, well, you really have limited rights. You're a owner of stock, but there are very few. Maybe you vote for the board of directors, but except for that, you really don't have much ability to influence the management of the company. Or in certain instances, you may give investors greater rights, and that may be a negotiated thing. And so just ask, what rights do I have as an owner of equities in this private company? And so that, again, it's just that relationship between ownership and control. And typically you're going to have very little control, but find out what you do, and then that helps you evaluate the safety of the reliability, the degree to which you're going to have to rely on management.
Exactly. So, Roland, what do you think? We've given a lot of good information here, I think, and also maybe we have some ideas for some further episodes. Maybe it's a good place to conclude.
Yeah, I think so. I mean, what we're really just trying to do here is, like we said at the beginning, give a quick law school class. But I mean, like Sarah said, this is a class that typically would last a semester, and we just did it in 31 minutes. So
exactly,
we're painting with a very broad brush.
This is a broad brush,
right? Yeah. But no, it's good, and it's good for us to describe these things, and we would welcome any inquiries from our audience members. If you want to talk more about these things with us or anything else that we talk about on AIM, we're available for a free consultation as attorneys.
Yes, and we look forward to talking to anybody. So, all right, well, thanks everyone for joining us today on Alt Investing Made Easy. If you like this episode, please like and subscribe to our channel.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.